Good afternoon. My name is Dawn McKnight, and I'm the Executive Director for the Independent Association of Home Instead Franchisees. On behalf of the association, I would like to welcome you to today's webinar titled Busted, Don't Fall for These ERC Myths in the Healthcare Sector. This is brought to you by Experian Employer Services, who is a valued vendor partner of the association. Since this is an intimate gathering today, I'm going to go ahead and allow all participants to talk. We really want to foster dialogue and conversation, but please remember to remain on mute if you are not speaking. Before I hand things over to our presenter, I'd like to share some information with you on his background. Daniel Heyman is the Director of Business Development at Experian Employer Service. Daniel supports clients to maximize the new employee retention credit and has secured over $300 million since its passage in March of 2020. Daniel has 9 years of experience serving clients in international tax, state and local tax, and tax credits and incentives. With Daniel's expertise in the healthcare vertical, he assists SNF, ALF, LTC, ILF, home care, and many more clients to navigate the ERC process. Now I'm going to hand it over to Daniel to start the
Thank you, Dawn. Appreciate everybody joining us today. Just want to make sure that we do allow people to talk, since it is, as Dawn mentioned, since it is a more intimate gathering. I think it's important to be able to answer any questions specifically that anybody may have. Feel free to just jump in. Again, if you're not asking a question, if you can mute yourself, that would be amazing. And as Dawn will be watching out for that. And as well, if there are any questions that you want to write in the chat, feel free to put that in as well. And Dawn, you let me know that if anybody has any specific questions there.
Yep, will do.
Thank you, Dawn. All right, so let's get started here. The title of our presentation today is Busted, Don't Fall for These Top 5 ERC Myths in the Healthcare Sector. And you know, a lot of these different myths apply definitely outside of the healthcare sector, but what we'll do is we'll try to tailor it to the healthcare and home care specifically, so that we are able to address any questions that or concerns that many healthcare clients and home care clients that I've spoken to have addressed throughout the last 3 years that this program has been in place. So we'll get started. Just a little bit about me. My name is Daniel Heyman, Director of Business Development, as Dawn had mentioned. One of the things Dawn did not mention, but a little fun fact about me is actually prior to my job here at Experian, which has been here for almost 9 years, I actually owned and managed my own home care agency out of Waterbury, Connecticut. So definitely familiar with the space, definitely understand the pains of running that. That might be one of the reasons why I'm not there anymore, because of those pains. But I definitely have all the respect for those on the call that are running their home care agencies. Definitely not an easy task and not an easy business to be in. But particularly with the ERC, I was able to assist many home care agencies to actually solidify a tax credit because of my knowledge in the industry and understanding how the ins and outs of the businesses work, although knowing that every single person runs their business a little bit different and has their ways of doing things. So right into it, we'll go into the 5 myths that we're going to be covering. Number 1, most people believe that the only way you can qualify for this program is if you have a significant revenue decline in order to be eligible. What I've seen again in home care, that definitely many clients have not had that, although some have for sure. But there are many clients who have not and therefore automatically disqualify themselves from the program. Number 2, my business must have been closed completely by the government in order to be eligible. Another myth that people believe, that you got to be completely closed, have to be that the Department of Health or some other agency, CMS or other agency, actually reached out and said you're not allowed to do business, or you were what was called a non-essential business. And obviously being home care, being essential, that's something that we'll touch on as well. If a company received PPP, number 3, if a company received PPP, they're not eligible for the employee retention credit. This was true, but it is no longer true, something that a lot of people missed out on. I don't have any other obligation, therefore we have no tax obligation, income tax obligation, and therefore we are TAMP exempt and not eligible for this refund. We'll touch on that as well. You do not need to be a for-profit organization. You could be a not-for-profit, and you can as well be eligible for this program. And the last one, my employees were always busy and therefore we are unable to claim this credit. Definitely true with the home care agencies. In general are either you pay your employees to do their job, and if they're not going to their client, then normally you will not pay them just because of the structure of the business model of different home care agencies. And lastly, bonus myth that we've definitely run into many of times is my CPA told me I'm not eligible, and either my CPA or payer provider claimed this for me or plans on claiming this for me. Definitely want to touch on that at the end if we have time to understand, how we work with many CPAs, many accountants to claim this credit. So we'll touch on that. All right, starting off with the first one. And again, if there are any questions, you definitely feel free to just interrupt or write a question in the chat. Happy to have any questions. My organization must have a significant revenue decline in order to be eligible. So for those who are not familiar with this, we'll just cover it to understand what this even means, a revenue decline. One of the ways to qualify for this program is if you have a decline in revenue when you're comparing 2019 to 2020 and then 2019 to 2021. And as you see here, there are differences between 2020 and 21. Throughout the entire program, you'll see that there are differences through 2020 and 2021. This is because 2021 came about in the second passing of this program, whereas 2020 was in the first write-up of the legislation. So number one is in 2020, you have to have a drop in gross receipts. And again, this is only one pathway. There is a second pathway. So those who are here looking at this and saying there's no way I had that, hold on tight. We'll get to the second pathway on the next slide. We'll discuss how you can qualify, even if you do not reach these percentages, even if you do not have a decline. But just going over this for those who may have it. And it's important to understand that I've met many companies who said, no, my 2020 and 2021 were much busier than 2019, and therefore our revenue was up. But when we actually drilled down into the quarterly numbers, so the way this works is if you have, for example, Q2 of 2020, you would compare that quarter to the second quarter of 2019 and see whether or not you have that drop. So we're looking at each quarter separately. We're not looking at the year as a whole. So a lot of times you'll have a year annual that you had growth, but when you look at it on a quarterly basis, there is one or two quarters that may qualify. So in 2020, that drop has to be 50% in any quarter. Again, comparing 2020 to 2019. And in 2021, that drop just needs to be 20%. Again, comparing that same quarter, 2021 to 2019. Go ahead, Don.
You okay if I interrupt you for a
Yeah,
question? Okay.
perfect.
Okay. If you opened your business in early 2020, are you only eligible for the 2 quarters of new business startup credit?
Great question. The answer to that question is no. Within those quarters, you will be, and I feel like I should explain maybe for the group, just in case that others do not know what the question is based off of. There's the recovery startup credit. And what that is that if you started your business after February of 2020, okay, if you started a business after February of 2020, there are some rules into whether or not you qualify, but without getting too deep into that. But you can qualify for the 3rd and 4th quarter of 2021, specifically on what's known as the recovery startup credit. That credit you can be eligible by qualifying as a new employer. You do for those quarters, to answer the person's question, for those quarters, you can only qualify for one or the other, right? For 3rd quarter and 4th quarter, you only can qualify for that. For the other quarters, you have the ability to qualify through the regular way, which is what we're discussing today. A great question. So back to the decline in revenue. So we have the 2021 20% drop. So again, this is definitely what we call the bright light test. This is the black and white test. This is the way you can look at it and see if you have it or you don't have it. And therefore, it's pretty simple to understand whether or not you qualify with this avenue. Again, to understand, this is the myth. The myth is that most companies believe that if you do not have this drop, you cannot qualify. That is a myth. You can definitely qualify based on impact that a government order or mandate has on the business operations. All right. And we'll go a little bit more into that based off of the next myth, which is that my business must have been closed completely by the government in order to be eligible. So this leads us into the second pathway of eligibility. All right, but before I get there for a moment, just wanted to make sure there are no questions on the first pathway, which is the gross receipts pathway. And we'll continue going. Don, no questions, right, on that?
Yep, no questions.
Perfect. So anybody has a question, feel free to either jump in or type it. My business must have been closed completely by the government or in order to be eligible. So the second pathway is what we're going to cover now in this one, is that if there was a government order, okay, a government restriction on your business that caused an operational impact on your business. Now, this is the key. The key is you have to have some sort of impact on the way you operate. The way you operate has to be different from the way you operated in 2019. One of the words that is used within the IRS notice, and the IRS notice, for those who are interested, I'm happy to provide that to you after this webinar, is basically the guidance that the IRS put out on this legislation. And the IRS specifically has a question on there about essential employers, right? Essential employers are employers that did not need to close completely for COVID. They're employers very much so in healthcare, very much so in home care, where you were able to continue your business, as we're going to put quotes on it, as usual, right? You were able to continue working the way you were working prior. You did not have to close down your business. The key here is that the IRS says specifically that there is a word that's used, which is modifications. Did you have to modify your business in any way in order to continue operating your business? And that's the way that an essential business can possibly be qualified for this credit, even without a government restriction, and even without a drop in gross receipts, and even without a full closure of their business, right? The idea here is that most home care agencies did not have to close. They did not have to close your business. You did not have to stop providing the service that you're providing prior. However, there are many states and many cities, many counties, I'm being from Los Angeles County, many restrictions here, and many home care agencies that did have specific restrictions placed on them for them to not be able to operate like they normally did in 2019. The first one that comes to mind to me that's automatic that I have seen is just the ability for those home care agencies that do provide services in facilities, right? In ALFs, assisted living facilities, or skilled nursing facilities, many home care agencies do provide within the facilities. There were some restrictions there where they were unable to provide. As well, the way you actually go out and get clients, right? Everyone's got their way of marketing, but the way you actually go out, some people go visit assisted living, some people go visit doctor's office, some people go visit, hospitals to solicit business, to try to get business for their home care agency. These are things that in many states, I don't want to say all, because I have actually seen a couple of states that did not necessarily have restrictions, but many states that restricted the ability to do this for home care agencies. And this is something that can possibly qualify your company for this credit. So again, the second myth, my business must have been closed completely by the government in order to be eligible. This is not so. The IRS specifically states that there is modifications. If modifications needed to be done for operations to continue, you can qualify. One of the important points for this that I do want to throw out there to understand, because it is important, is that the IRS states that you have to show a nominal impact to your business. Okay, so you have to show that there was a nominal impact to your business operations due to this government order, right? So again, there's stage one is that there's a government order. Step two, that government order caused a restriction on your business that caused a nominal impact to your business, right? So we just have to make sure that that nominal impact is there. What does that look like? A lot of times that looks like, for example, we can use the amount of patients, of seniors that you are servicing. If that went down, we can do that. If, for example, you had a portion of your business that went to skilled nursing facilities and a portion of your business that did actual in-home services, right? We can compare the two and see, did the skilled nursing facilities business go down completely, and therefore that's 10% of your business. As well, we might be able to just see that you do have a decline in revenue. Some people do have a decline in revenue, but it's not that 20, 50%, but it's 10%. That shows that there was an impact to your business. All right. Going on to the next one. Again, any questions, feel free to interrupt. The third one, if a company received PPP, they're not eligible for employee retention credit. So this is something that was a restriction. Again, I mentioned earlier, there was a restriction when the first legislation came out. There was a restriction that you had to choose between either PPP or ERC. You were unable to get the PPP and go after the ERC at the same time. Now, as a business, as a tax credit consulting business that we are, we had a lot of clients in our tax credit department that were above 500 employees. And if you remember, PPP was specifically for employers of 500 or less. Because of this, our department got involved with ERC very early on. We got involved with ERC already. The second this first piece of legislation in April came to fruition, we were already helping our clients capture the ERC credit for all those clients that we have above 500 employees. At the time, you were unable to get the PPP and the ERC, so therefore most businesses, I would say pretty much all businesses who are under 500 employees went after the PPP versus the ERC, and rightfully so. The PPP was dollar for dollar. The ERC was 50 cents on the dollar for that at that period of time. Since then, in December of 2020, when the second pass of the CARES Relief Act was passed, there was included in that you are able to take advantage of both the ERC and the PPP, and therefore many small businesses started going after that beginning January of 2021, and we've been able to assist thousands of companies throughout the US capture this credit since then as well. And there are some limitations, and there is, I would say, one small limitation, and it's definitely a limitation that causes maybe your credit to be a little less than it would have been if you did not take PPP. Now, limitation is that whatever wages were paid for with PPP, you are unable to take the ERC on those wages. So the government just doesn't want you to double dip, right? Why give you a tax credit on money that was paid for by the government? So therefore, the government has specifically, the IRS has specifically said that any wages that were paid for by the PPP, you are unable to take an employee retention credit on. You are able to take, again, the employee retention credit with the PPP, even during the same period of time. There are ways to put guardrails around the wages being paid for with the PPP and therefore leave the leftover wages for the ERC. There are many different techniques that we do to be able to maximize your ERC credit. So it's not a matter of period of time, it's a matter of PPP versus ERC, there's the actual wages paid. Okay, going to number 4. I don't have any income tax obligation, therefore we are tax exempt and not eligible for this refund. So this is definitely common. I think more nonprofits have realized that this is something that you can take advantage of, even if you are a nonprofit, even if you do not have any income tax obligations. We definitely service a lot of clients with other tax credits. One that you may be familiar with is the Work Opportunity Tax Credit, the WOTC, which is a hiring tax credit. And in that case, besides for veterans, nonprofits are unable to take advantage of that credit because at the end of the day, it's an income tax credit, right? And if you are a nonprofit, you do not have an income tax statement. And if you don't have an income tax statement, there is no benefit of taking an income tax credit. As well, if you have losses, right? And you have NOLs, you have net operating losses on your tax return, and therefore you do not owe any taxes. With WOTC, with Work Opportunity Tax Credit, you wouldn't be able to take advantage of that credit for the year that you have the net operating loss. However, with regards to the employee retention credit, the ERC that we are talking about today, that is a payroll tax credit. The Treasury essentially wanted to figure out the best way to disperse funds to small businesses, and they chose to use the payroll tax as the conduit to send small businesses such as yourselves the money for COVID relief. That's really essentially what the Treasury was thinking of by putting it here. A lot of questions that I have as well with the payroll tax credit is I don't pay that much in payroll tax, right? So therefore, I'm only going to get as much as my payroll tax. Actually, with regards to this specific tax credit, it is refundable. So just like if you have a refundable credit on your income tax credit, you'll receive a refund check from the IRS. You will get a refund check for this payroll tax as well. So therefore, even if you pay, $10, $20, $30,000 in tax credit in taxes on your payroll tax, your tax credit can be as much as a few $100,000. I've even seen the millions upon millions, tens of millions of dollars some companies have received in this tax credit. The way that works, just to understand the calculation, is that this tax credit is a percentage of the amount of wages paid to your employees during the period of time that you are deemed an eligible employer. So, for example, if you are eligible for the first quarter of 2021, that allows you to take up to 70% of wages capped at $10,000 of wages per employee as a tax credit, essentially $7,000 in credits per employee you can earn in that first quarter. And I think that I want to touch on that point as well, is that a lot of people look at this and say, I don't qualify. I always say it's worth it to look again. I've had many companies that said they did not qualify, and we've qualified even for one quarter, right? We're 6 quarters at play. Even for just one quarter, they've qualified. And I think it's been if you think of the business for specifically in healthcare and specifically even more in home care, where payroll costs are your number one cost, right? You're very payroll heavy company, very payroll heavy industry. You can imagine that the tax credits can add up pretty quickly. If you think about your pay period, the amount of payroll goes out on each pay period, if you get 70% of that, even for just one pay period, you can imagine it can add up pretty quickly. So definitely something to look into. Okay, and the last one that we're going to go over is my employees were always busy and therefore we are unable to claim this credit. So this is specifically for sure. I see this very much so in the home care space. And I want to discuss here a moment just large employer versus small employer. Okay, and what that means is if you are deemed a large employer, and we'll go into a little bit what that means first. A large employer in 2020 is different than a large employer in 2021. Again, we've mentioned that 2020 was already rolled out in April of 2020, and 2021 only came along at the end in December. So therefore, a little bit different tweaks that they made. In 2020, a large employer is called a large employer if they had 100 or more full-time employees in 2019. Okay, and we're looking at 2019 as the base period for this as well. What is a full-time employee? So the definition that's used for full-time employee with employee retention credit is the same definition that's used for the Affordable Care Act, the ACA. And if you're familiar with 1094C, it can be found there. It's a form 1094C. And what that is an employee is considered a full-time employee if they work on average in a month, 30 hours a week. Okay, 30 hours a week on average in a month. And the way you calculate your large versus small employer, the way you calculate your full-time employees is you add up every single month of 2019, you add up how many employees you had in each month. You add up how many you had that worked 30 hours a week on average. And you add up all those numbers, you add up each month, 12 numbers, and you divide it by 12. If it's below 100 employees, you're considered a small employer. If it's above 100 employees, you're considered a large employer, okay? For 2021, that 100 number just changed to 500, right? So that becomes, if you're above 500 employees, you're a large employer. If you're below 500 employees, you're a small employer for 2021 specifically. And again, using the 2019 numbers. We're always using 2019 numbers to calculate that number. So assuming you're a small employer, the rules are for a small employer, if you are deemed a small employer, you are eligible to take all wages paid during the period of time that we find your eligibility, all right? So that means that if we find that you are eligible for one quarter, again, we use quarter 1 of 2021, if you are eligible for that quarter, you as a small employer are able to take all wages paid to your employees during that period of time to calculate this credit. Okay, so we'll just quick example. You have 10 employees, let's say, and each employee, makes on average, let's just say, we'll call it $800 for each pay period, and $1,600 a month, which would come out to $4,800 a quarter, right? So let's just say each employee makes $4,800, and you have and you have 10 employees. So that means that your payroll is going to be $48,000 over a quarter, right? You're able to take 70% of those wages, or each employee, right, will be able to take 70% of each of those employees' wages as a tax credit, right? So we're talking about roughly around $30,000, just doing the math quickly in my head. So hopefully I'm a little pretty close to the number, around $30,000 to $32,000 in tax credits for those employees. So you can see, as a 10 employee company, right, small company, 10 employees, making not too much over there, $400 a week. That's probably in most places way below minimum wage, but just giving that example that you still can earn, $30,000, $35,000 in tax credits for that one quarter that you are eligible for. Just to touch on the large employer piece for just 1 minute, just in case there's anybody there that may apply to. Large employers, and this gets a little more sticky, but there is still definitely eligibility possible. Large employers are only able to take wages that were paid to employees that did not provide a service, okay? Now, this is a lot more difficult in the home care space, for sure, right? Because at the end of the day, we mentioned at the beginning of this, that home care, you're either paying your employees because they are going to their patient, to their client, or you're not paying them if they're not going, right? It's very rare that you're going to pay an employee to do something to do nothing, really, right? If you think about just to give you an idea of what type of wages they're referring to, is if, number one, if let's say you have layoffs and you continue to pay healthcare, you're able to use the healthcare payments. Number two, you may have some employees who went on COVID and you weren't able to claim the FFCRA, which is the credit for paying COVID relief, and you didn't pay that, or you paid the wages, but you didn't claim that credit, you're able to take this credit for those wages. So I'm not going to stay too long on the large employers, but essentially, right, people think that because their employees were always busy, therefore they're not able to claim the credit. Definitely able to claim the credit, especially as a small employer. You're able to claim all wages that were paid during the period of time. You're able to take a credit on those wages for this program. Okay, and finally, the bonus myth. My CPA told me I'm not eligible, or my payroll provider claimed this for me, or plans on claiming this for me. It's really important to understand the complexities of this program and the ins and outs of this program, and really to understand that you go to, if you want to we always say that there's a difference between going to an accountant or using one of these accounting softwares, right? Tax Act or things like that, that you're able to just go on and apply for taxes yourself. It definitely can be done, right? You definitely can go to your payroll company. I would say most payroll companies are doing it today. You definitely can, but essentially what that is putting the onus on you, right? It's putting all the responsibility on you to determine whether or not you qualify, whether or not you are actually able to take this credit. What we do for you is, number one, is that we bring expertise within this industry, within the payroll tax industry, and within tax credit industries, right? So we've got experts specifically in the payroll tax world, we have experts specifically in the tax credit world, and we've got experts that have been working on this ERC, even together with the Ways and Means Committee, hand in hand, to make sure that everything makes sense, which we've definitely gone back and forth with them on that. The IRS notices are over 200 pages, and like I said, I mentioned, happy to provide them to anybody who is interested in reading it. I think it's interesting. I don't know if you all will think it is, but definitely it's something that needs expertise in. When we talk to accountants, we work with many, many, many accountants as a supplement to their services. Accountants' main job, right, is to make sure you're paying the right tax, right? Our job is to try to get as many tax credits as possible for you. So many of my partners are accountants. And when we've been able to let them know, accountants are number people. They don't claim to be tax attorneys. There are some that are both. But when it comes to complexities of the taxes, and specifically in this program, a lot of them tend to lean to the numbers versus the actual conversation and the facts and circumstances that we can put together to qualify for the government order side of it. So that's what I have. If you have any questions, feel free to email me. If any questions now, love to open it up. I know it's been, I figured we'd get through this a half hour, give some people a break for the day instead, but just pause for any questions.
Thanks, Daniel. Yeah, I just put something in the chat. If anybody has a question, I mean, that was so much information. I can't believe people don't have questions, but sometimes it takes a moment to, digest everything. But yeah, they can either unmute or type it in the chat. Now, is it possible to share the PDF or any of this with the folks that attended today?
Yeah, for sure. We could definitely share the PDF. And Don, you could determine whether or not you want to put it on the website or not. We could discuss that. But as well, if anybody has any questions, my email's there. Definitely feel free to ask any questions. I always say it's worth the 15-minute call. I'm happy to go through it. I'm not here to push you to tell you that you qualify. That's not what our job is here. Our job is to see whether or not there's a pathway to eligibility. We're not going to take a credit that you don't deserve. We're not going to end up claiming a credit that's risky. We will make sure that we go through our process and make sure that we actually, whatever it is that you do claim is something that will hold up an audit. And that's the key, right? Our goal is to make sure that we can deliver to you an audit ready package.
Oh, that's perfect. I do have one question. Okay, so do government orders have to be guidelines or mandates in order to be eligible?
That's a good question. So it really depends on who the government order is coming from. Now, I'll give you an example, right? When the CDC gives a suggestion, as they call it, right? When they give a suggestion that you should have 6 feet social distancing, it's definitely argued that that is considered a government mandate, right? At the end of the day, we all know the type of governance that the CDC had during the pandemic, and therefore that would be considered a government restriction. It doesn't necessarily need to be that you have to do ABC suggestions. And again, it really depends on which government entity is providing those suggestions, but definitely you can have as well. Now, on that note, I do want to say that when it comes to specifically your internal decisions, right? So let's say you decided internally that you're going to be more careful and therefore not, let's say, provide services to specific types of clients, that would not qualify, right? Because that's an internal decision, although we applaud you for it, for being more careful or putting those in place. It does need to be based off of a government restriction. We do need to find that government, either restriction or order that has been written up. So hopefully that answers your question.
Okay, that's great. Thanks, Daniel. So I have somebody else who wants to know about the fee. So the Experian fee, is there a percentage? Is that something you want to share, or is that case by case basis?
No, it's definitely something I'm happy to share. Yeah, our fees are definitely based off of whatever we find you. It's a percentage. If we take you on as a client, so I'll just tell you that I'm here. I'm a director of business development here at Experian. My main job is to see whether or not you have a pathway to eligibility, which means like this. And I want to clarify this because it's a great question about fees. Is that after a 15-20 minute, sometimes a little bit longer conversation with you, I'll be able to determine whether or not there is at least a pathway forward. What that means is that I believe it's not a waste of your time, and I believe it's not going to clog up our system to bring you on as a client, because I believe that there is possibly a clear pathway forward. However, what that doesn't mean is that you automatically qualify. It does not mean that. What that means is that you're going to go through our process, and our team of analysts is going to analyze data. When you're talking about government orders specifically, you are talking about a facts and circumstance type of qualification. And therefore, really based off of data, really based off, for example, what government orders there are, how that impacted you. And therefore, we don't guarantee any qualifications really, until we go through all the data and everything of that sort. That being said, our fees are based off of the last stage, which is we've gone through the qualification stage, right? We've already determined that you do qualify. We've already determined which quarters you qualify for. We already got payroll from you to calculate the credit of what you're going to earn for this tax credit. And on that is what we'll charge a percentage of the amount of credits that we end up determining you qualify for.
Okay, so just to clarify, does that mean, just for myself, so there's
Yeah.
so there's no fee until you get to the point where you're going to get a tax credit, and then there's a fee applied to that, a percentage applied to that. So there's no out of pocket to do the investigation.
Correct. That's exactly
Okay.
right. So if
Okay.
we determine at the end of the day that you don't qualify, right, the facts and circumstances are not there, you don't notice a dime.
Okay. All right. I think that's probably very valuable information.
Yeah,
Let me see. Okay, so I don't see any more questions.
great.
But I do, I mean, obviously, oh, wait, got another one. Okay, do you guys help represent clients in the event of an IRS audit?
Great question. So I'm going to clarify that question and be totally transparent, because that's the way I am, and hopefully I have been this whole time as well, and you realize that. We support you in audit. So to be clear, I know you said the word represent, whoever asked the question, I know you said the word represent. I want to be clear, we support you in audit. I actually had recently somebody who, I have a blog on skilled nursing facilities, and somebody found me and said that they are being audited by the IRS. They did not use us to calculate the ERC, but they are being audited by the IRS, and they wanted our assistance. And we have helped them through the, I should say, we're currently helping them through the process. We hope so far it's turned for the better. They were going to be denied $1.4 million. And today, the agent who is on their case has brought it up to his supervisor. So that's always a good, a better sign than him just denying the $1.4 million. So what that means is that whatever is necessary for an audit, we will provide you, right? But we do not represent in an audit. So hopefully that's, usually the accountant will or somebody else will represent you for the audit.
Oh, that's great.
But to understand that is included in our fee as well. That support, audit support, is included in our fee with regards to the ERC.
Okay, so no additional percentage is taken for the support.
No.
Okay, great.
It is included.
Okay, great. That's perfect.
And,
Okay.
definitely something to keep in mind when you are, I'm sure you're talking to many vendors, because I'm sure many vendors are reaching out from what I've seen since we started till now. I think probably thousands of new vendors have popped up since we started back in 2020 with this program. But something to keep in mind when talking to those other vendors is their audit support, and is it included? Because what I've seen, and I think this might come back also to the accountants who are doing it, a lot of accountants as well will not include their audit support, and a lot of accountants will end up charging for the audit support, and sometimes that could be pretty hefty.
Okay, so I have a follow-up question from the same individual. Is there a window to file within?
Yeah, great question. So we just passed the 1 year mark, which means that we've got a year left. The first deadline that's going to come up is April 15th, 2024. Okay, and the reason why that there's a deadline there is because of statutes of limitations. The way you're claiming this credit is on a 941X. Everyone's probably familiar with the 941. It's the quarterly payroll tax return that you file every single quarter. Those are filed on a quarterly basis, and the last one is filed, it has to be filed by April 15th, 2024, April 15th of every year. So therefore, the 3-year statute of limitation for 2020 will be up April 15th, 2024. That will be the first statute of limitation that passes. Now, you still will have another year for 2021. So you still do have 2 years for the 2021 credit, which, as we mentioned, is the larger credit. In 2021, you can earn up to $21,000. In 2020, it's $5,000 per employee. So definitely the larger credit is in 2021, and you do have another, I guess, a little bit less than 2 years to claim that credit. But this does take time. There's no question. It does take time for us to go through our process, and it takes time for the IRS to deliver the credit. So, if you're looking to get this done, definitely worth it to get it done sooner than later. Just because of the fact that what I've seen since the beginning is that as more and more people hear of this program, I would say the process probably takes a little slower, and therefore definitely quicker the better for you.
Okay, great. So if anybody's interested in pursuing the investigation of their potential eligibility, they should just email you and then they can set up a time to talk.
Perfect. Yeah. 100%. And definitely we can set up a time. You can email me. I would even provide my phone number. I'll put it maybe here in the chat just for people to have. Or let me see if I'm able to do that. Yeah, I think I could. I'm gonna put my direct line, because sometimes people don't. Sometimes an email is just gonna take them too long, and maybe just as a quick call, and we can do that.
Okay, great. And I just another quick question. What is the IRS look back?
Okay, I'm gonna just qualify this question, just make sure. And Bradley, I see that you're the one who wrote it, so there you go for audit.
Oh,
Thank
for
you.
audit.
Okay, good. Thank you for qualifying it. Okay, so for Q3 and Q4, okay, of 2021. Okay, so there is a little bit of difference here, and you may have heard about this. Q3 and Q4, the IRS has 5 years to audit. Okay, for every other quarter. Right now, and I'm saying right now because I know that has been talk about expanding this, which is not great for us, but if it is, we're okay because we know that our clients are pretty much covered. It's 3 years, right? But to understand that, it's 3 years unless you file. So, I know in the beginning, even for myself personally, when I was starting to learn this a little bit better, I was like, hey, why doesn't everybody just file this on April 14th, 2024, and then they don't need to worry about audit, right? The IRS is 2 years from the time that you receive your credit. So no matter when you file it, right, the IRS has 2 years from the time that you receive your credit to audit you. So yes, the statute of limitations is 3 years, but the IRS has another 2 years from the time that you receive your credit. So Bradley, hopefully that answers your question. All right. So, and I just want to make sure, Don, that number, it went through to everyone, right? I just want to make sure.
Yep, I see it. Yep, went through to everybody.
Okay, perfect.
Yeah, Bradley said thank you. So you must have answered his question.
Okay, perfect.
All right.
All right. Well,
fantastic.
Yeah. Any other questions? Feel free to email me, phone call, whatever it is. You can call me the second this is over if you have a question. And happy to give you back 17 minutes in your day, everybody. No need to keep you on any longer than we need to. Don, I appreciate you setting this up and our partnership that we have, and I look forward to many more interesting webinars together.
Yeah, absolutely. Well, thank you for your time. It's been, great working with you and the team at Experian. Again, we appreciate your partnership as well. Yes, we'll plan something maybe in the coming months for a follow-up, and I'll get the PDF out to folks that attended the webinar, and I hope everybody has a fantastic rest of their day. And we'll see you all hopefully next month.
Thank you so much.
Take care now.